Start from page 27. Okay, can you work from 27 onwards? Page 27. So 27, you see that there are some questions. Yeah. So you are going to try out page 27. So 27, actually you're supposed to fill up two things. So one is to fill up the purchases, and the other is the some additional capital. So two things. Just start by trying to record. Okay. So start by preparing T account for this page 27. And then after, the other thing is to prepare the journal entry. This question, okay? This one. Page 27. Okay, start now. You have about 5 minutes to work through page 27. Okay, you can start now, page 27. Only one question. So two things, T account and followed by the journal entry. You can begin. Spend about 3 minutes. Okay, maybe another 2 minutes. Start with the T account, and after that the double entry. Start with the T if you are not sure where to start from. Okay, so you get the idea. So something like this. Okay, so let's have a look at it. Okay, so as mentioned to you before, for recording the entry, you can use whichever rule that works for you, or you can use Alice. The most important thing is make sure you know where is the plus and minus sign. That's very important. In the exam, not likely that you have to do the T account, but in the exam, they will surely ask you for double entry. The double entry is for sure will be tested. Okay, let's come to this. Okay, there are many names for goods. The term that you will see in the exam would be inventory. So this will be the term that would be used. Okay, so like that. Okay, so let's start with the goods of 200 bought on credit. Since you bought goods on credit, that means the amount of inventory increases by 200. Okay, whereas on the other hand, your payable increases by 200. So payable is a liability. The sign would be credit plus. Debit on the other hand is minus. Okay, and fill in the corresponding description, which is not very important for exams, right? Because in the exam they are not going to ask you to do T account, so this wouldn't be so important to you. Okay, well, how will we write the double entry in this case? The double entry simply would be debit inventory and then credit payable. Right, so it's quite straightforward. Some cases they use the term trade payable. Is it anything different? No, nothing different. But if you see trade payable, it simply means payable. There's no difference. At work, I think some of you may even come across this term called non-trade. Right, we actually have this distinction, but you know what? For purpose of exams, you only need to know that trade payable is the same as payable. They mean the same. Okay, there is actually some difference in practice. Okay, let's come to item 2. Goods of 350 were bought for resale, and this was paid for by cash. So what you need to do quite easy. Okay, so you bought 350 worth. So your entry therefore would be, if you want to use a different color, or maybe you can just put number like that. Okay, so the second entry would be that you have bought goods for resale, right? And then you bought 350 worth, right? And then the corresponding would be cash, which is the sign plus and minus. Right, so the 350 here, what's the description? The description would be inventory, and here cash. Okay. Okay, good. So the double entry how? Debit cash, credit inventory. No, wrong side. Debit inventory, credit. Yeah, right. Simple. The easy thing for you is that you just have to pick the correct one in the exam. Okay, you don't really have to worry over how to write. No need to worry about how to write. Just make sure you pick the correct entry. Okay, so 1 and 2 done. Let's come to 3. Started business with 1,000 cash. Okay, so when you have a statement like this, it means that there is capital. So there is capital of 1,000. And it also means that you have cash of 1,000. So this is entry 3. So cash and capital, right? And make sure that you repeat and record the double entry correctly. And we are done. Okay, quite simple. The not so simple part is actually the standards and the theory. The standards and theory will be the one that will give you a bit more problems. This one is still quite fine, not too bad. Not too bad actually. Right, not too bad. Let's come to 4. Okay, item 4. 4 says that you purchase equipment from supplier ABC 4,000 on credit. Now, so this one obviously means that there is equipment. Now in your exam, you have to watch out whether this is for use or is it for resale. If it's for use, then it's an asset. Okay, it's a non-current asset. However, if it's for purpose of resale, then it becomes inventory. So in your exam, you need to confirm like which one is it. Okay, but usually quite straightforward. It won't be so difficult to guess. Okay, so in this case, let's say it is for business use. What would the journal entry be? The journal entry, so you need to start another 2 more accounts, right? You need an account for equipment, another account for, oh, this one just payable account. Do you have payable account? Actually, you have. Right, you can use the same account. So you need to have an equipment account here, equipment account, equipment, debit, credit. Okay, so your equipment account will have 4,000 and you bought it on credit from the supplier. So this one, the entry would be, here would be equipment, the other side would be payable, right? So how would you write the entry? Debit, equipment, and then credit, payable. Okay, so far so good. Quite easy actually, not too difficult yet. Okay, next one. Okay, the next one is the monthly rental of 2,000 paid. So monthly rental 2,000 paid. Okay, monthly rental. So you need an account for rental and rental expense. Okay, monthly rental paid. So how much is the rental that you paid? 2,000 paid. So what I need to do is 2,000 cash and then 2,000 rental, and that's done. Okay, transfer this to your double entry, debit rental expense and credit cash. Similarly 2,000. Right, no problem. Simple. Okay, the next one would be 6. What is 6? 6 is that you paid out amounts of 500 for maintenance. 500 for maintenance. So you need to have maintenance account. Maintenance account. So you paid 500 for maintenance. Right, 500 for maintenance. So 500 for maintenance. And what you need to do next is that similarly make sure you update here 500. Right, so your entry in this case would be debit maintenance and credit cash. Amount 500. Okay, easy, not too difficult. The main thing that you need to know is the double entry. This is the most important part for exam, the most important part. Right, the rest, the T account, later on you may use it for working, but you don't really need to do the T account. Not so necessary. Okay, so that's done for double entry. Okay, now do you remember the double entry rule? Double entry rule has 2 very important things that you need to know. And the 2 very important things is that Each transaction has 2 or more effects. And the second one is that the debit and credit amount must be, yes, they are equal, right? Always equal. Right? You may get something which where the question may test you true or false. Right? They may ask you like a few things. Is it true or false? Okay. So that's not too bad. Okay, let's come to our next stop point. Next stop point, huh? Okay, so that's done, huh? Okay, let's look at the what else we did, huh? Okay, so we come back to this very important thing that we didn't do the last time. So this is called journal. Okay, journal is quite important. Why is journal so important? Maybe we look at the earlier page, 25. Now when you look at this key account, maybe look, let's say the first one, 2000. What does it tell you? Are you able to understand what's the purpose of this 2000? Maybe by looking at the entry you can guess, oh, it's a sale of goods, 2000. Right? Maybe it's a sale of goods. Right? But you can't tell any more detail other than this. There is no information. How about this one? We see that there is 1,000 here under rental. What does it mean? Does it mean that you pay rental early or pay rental late? Again, you can't tell what's the detail. No detail. It's only number, the description, and date. That's all. Not enough detail. You can't tell, like, are you paying for last month or paying for this month or when? Can't tell. So that's where we have this very important item called the journal. Journal is actually a record of a few things. Basically the date of the transaction. It also gives the double entry. Okay, and then it has a reference column. We call it folio or reference column. For purpose of exam, the folio or reference column isn't important. Right, you can skip that. But normally we may put reference, we may put like which file is it. Right, but otherwise for purpose of exam, it's not important. Okay, then you see after you fill up the double entry, debit credit, you fill up the corresponding amount. Now this one has one more extra step. The extra step is that you fill up the, what we call the narration. Narration means that you fill up the explanation about what this double entry is about. Okay, narration. N-A-R-R-A-T-I-O-N, narration. Right, it also has a narration line. Okay, let me just demonstrate with the following example. To illustrate with an example, goods were sold for $500 cash. So what's the journal entry going to be? Let's fill up here. Let's try to fill up. Oh yeah, there is no folio column I told you, so you just cross it out. Okay, you fill out the date first, whatever date that you have. You sold goods for 500, so what you need to do is just fill out cash and cash and inventory. I'm going to cover a bit more about this thing later on. Okay, you notice I didn't fill up DRCR. You notice that? But it's fine because you're going to fill up here DRCR. So inventory you sold for 500. So debit cash 500. You see that? Same line. Credit inventory 500. The journal entry or the narration here is, many people like to start with the word being. Being goods sold for cash. You can write like that. It's fine. Okay. Now let me ask you, you think exam will ask you for narration? Answer is, don't have. Exam they won't ask you for narration. The only thing that you will get in the exam is, please write the double entry. Right, that's all. Okay, however in practice, when you prepare the journal entry, you actually write down the narration. Like, hey, what is this, and what's the purpose of it? Is it for last month? Is it for this month? Is it, a refund? Whatever it is. Okay, so this one, all you need to do is make sure you know the double entry, right? So this is the example. Quite simple. Right, so ultimately when you go home to prepare, make sure that you're super familiar with the double entry, debit and credit. Right? Especially how to do this. This one is the important thing. Right, make sure you know how to do this stuff. Right, the important thing. Now next question, when do you actually see the journal entry? Okay, let's come to a quick refresh. Right, you remember, in your accounting system, the very first important thing that you must have is the transactions. And transactions must give you the evidence, the source documents. Right? What kind of source documents are we talking about? The last time I told you, you only need to know about 4 of them. Source documents include things like invoice. Yes, correct. Your CN, credit note, debit note, invoice, receipt, and some other documents. Right, so based on these documents, then these are all recorded where? In your accounting system. And the first thing that all these transactions go to is that they go into this thing called the books of prime entry. And you remember, in the books of prime entry, you have various items. You have in total how many books? 6 or 7. Right? 6 or 7. Right. So the books would be mainly, right? Mainly which ones, if you can recall? Right. Yes, right. The sales day book, right? Yep. Purchase day book, and you also have the sales returns day book. Yes, correct. Purchase return day book, and we have cash book, and very important, petty cash book. And someone was saying the last one is, yes, correct. So the narration, like the details of the purpose of the transaction, can be found in these book of prime entry. So the book of prime entry may have certain details, like what's the purpose of the transaction? Is it return of goods? Is it sale of goods? Right. The general journal even more detailed. General journal basically looks like this. This is general journal. Or many a time what we do is that we just simply call it journal. Right? You don't really call it. I mean, some people just skip the word journal. They just refer to it as journal. It's the same. Okay, so that's this. And we come to our next important stop point. Yep, so it's only after the book of prime entry then you get into the what system? You get into the ledger account. The ledger account. Ledger account, we'll be talking about it in more detail. The most important ledger is actually the general ledger. This is the most important one, right? And what about these? What are these accounts? Where can you find all these accounts? These accounts you find here, all these they are found somewhere. That is what I call, including these. Where do you find them? General ledger. Right, all these T accounts. All these you will find under general ledger. General ledger has all the T accounts. Right, most of the T accounts. Okay, so that's this. Now there is one problem with general ledger. That is, okay, I put a star here. It may not apply to your business. Some companies, they do differently. Okay, but for purpose of syllabus, we say that like, let's say if you look at this T account. Let's say you look at this T account. You bought inventory from whoever 200. You bought another party 4,000. But do I know who is the supplier? Cannot tell. Why? Because it's just inventory 200. Can't tell. Can I tell who is the party supplying the equipment? Also cannot tell. Can I tell if you have paid for the inventory? Have you paid the supplier? Also cannot tell. Right. So this is not very clear. Right. So what we have is that we have this thing called the payable ledger. The payable ledger basically gives you the individual supplier, or you can say payable. T account. So that means in the payable ledger I can find accounts like AR, BR, C, supply ABC. Then in my general ledger I also have a payable account. But these two payable accounts are a bit different. Why? Because the payable account you find in the general ledger is a total payable account. That means it's for, let's say for example, let's say you buy 10 from A, you buy 30 from B, you buy 40 from C. So in your total payable account, you only see one lump sum, 80. Right. So this total payable account only shows total, it doesn't give you breakdown. And you have to go back to the payable ledger to see the details. Like A, I have 40, did I pay him? Or I have 30, have I paid him? 10, is it still owing? Or has it been paid? Right. Okay, so that's this. Another very important thing is that the two here that you see, this one, the payable ledger has no double entry system. That means the recording is only one side. So if you see 40 here, you cannot see a debit 40. You cannot find. It's only one side. Okay? We do give this a special name, which is not so important to know for exam. We call this accounts here memorandum accounts. But do you need to know this for exam? Not so important. Okay. How about the general ledger? Okay, general ledger here. The general ledger, however, doesn't have. The general ledger, however, has double entry. You can see the double entry in the general ledger. How do you see the double entry in the general ledger? How to see? Okay, let's go back to my example. Can you see? Can you see this? Debit inventory, credit payable. That's double entry. Right. So my general ledger has double entry like this. So I have credit equipment. So I have credit payable, debit equipment. You see that? So this is double entry. Double entry you can find in the general ledger. It has double entry. Okay. However, you know what? If you use ERP, the ERP will not tell you payable ledger or general ledger. The ERP only gives you, please key in the number, invoice value. Right? You can't see the double entry. You can't really see exactly. Okay, last one. And there will be a separate ledger which we call the receivable ledger. Receivable ledger is actually for individual. It's a record of individual receivable accounts. Receivable T accounts. So like for example, if you have like 5 customers, then the receivable ledger will have 5 customers. So maybe if you have 5 customers, like maybe K, L, H, maybe J. Right. So in each of these customer accounts, you find details like how much you sold to K, how much you sold to L, how much you sold to H, and how much you sold to J. Right. However, when you look at the general ledger, the general ledger you only see total receivable account. And if you see that here got individual, add up 180, right? 20 plus 60 plus 80 plus 20, add up. If you add up, it gives you 180. Then in this account here, in general ledger, it's only 180. Right. So in the general ledger, you cannot see the breakdown. It's always just the lump sum, the total. Right. Now the term we use for this is that we say this is payable control account. If you heard of that, and this is called the receivable control account. Right. So this is the purpose of control account. Control account lets you know what is the total transaction. Right. Is it important to know now at this point in time? Not so. Okay. But you have to remember, only general ledger has double entry. What about receivable and payable ledger, would these two have double entry? The answer is that these two, there is no double entry. No double entry. But some ERP, what they do is that there is double entry. Okay, that one is a separate thing. If you want to know, like, hey, what about my office? My office is ERP. Then is it the same? Is there double entry here? Receivable ledger. Now, what some ERPs do, not required for your exams, but just to let you know, like some accounting systems, they don't have this kind of situation. This one very important last time, you know why? Because last time you use pen and paper, so it's important now that you separate the work. Right. So then all these the payable and receivable ledger doesn't link to general ledger, no link. But now what happens is that if you use the ERP, what happens is that the ERP, when you have a transaction, when the transaction occurs, when you record, let's say you post, when you post the transaction, the moment you post, it goes straight into general ledger, payable ledger, and receivable ledger. And this is automatic. Automatic, it flows over to the three of them. So then in your general ledger, you have your double entry. Right? And then in your payable ledger, maybe you have your whatever accounting entry. Right? And then ultimately, this one automatically flows into your P&L, balance sheet, cash flow statement. Right? But last time, you know what? Last time, in the old days, because you don't have ERP, last time there is no auto post. Last time someone must manually post into the book of prime entry, manually post. Then someone must manually prepare the GL. Another person must manually prepare the payable ledger. Right, you fill out the payments to each supplier. Then you need one more person for receivable ledger. So you need a lot of people last time because there is no ERP. But now you know what? Now you don't need to worry about it. You don't need so many people. You just need one person. One person do everything. And that's why I got you. No. Or maybe you need just 2 persons. Right? Okay, and that's the benefit of using ERP. Right? Okay, do you need to know this? Not important. Right? It doesn't apply to you in exams. But that's how it works. Now, and why people have these 3 ledgers? In fact, they even have a 4th ledger. But it's not in your exams. Right? That's the thing, 3 ledger. Last time people have different people doing the 3 ledgers. Okay, long story short, important, please make sure you know your double entry. And we got some more examples. Okay, maybe just to, before I move on to the next item. Okay, now one problem with this kind of recording is that if you have sales, the sales go into the inventory account also. You know something? If you sell something, you record on the right. Now there is one slight problem. When you buy the cost price and when you sell the selling price, these 2 amounts are not the same. Right? Why not the same? Of course, if you buy 100, you cannot sell for 100. If you buy 100, you must sell for 120 or more, or maybe 130. Right? So these 2 amounts are different. So usually what happens is that there are quite a number of ways to record this. Right? There is the perpetual and the periodic system. However, we are not going to cover these 2 systems today, right? And both systems are quite commonly found. Depending on which system that your company use, it will also affect the entry here. Okay, some people what they do is that they record this as purchases, which means that anything that they sell, they put under sales account. Okay, so then the good thing about this kind of recording is that cost price, one account, selling price, another account, selling another account. So it's very clear, right? So you don't mix the cost price and selling price together, right? So I will tell you more about like how do we use purchase and sales to record. Okay, a bit more and more, right? Now, is it wrong that you record as inventory, this is actually a way of recording. Now this way of recording is called the perpetual system. It's called the perpetual system. Right, perpetual system and everything also throw into inventory, but there is more things to it. I'll tell you more about it. Okay? Right. Okay, but tell you more details in a while. Okay, so this one coming up later on. Right. It will be a very important topic. Okay, let's move on to the next one. Okay, I'm going to also use this example to explain to you how to record using the perpetual and then also the periodic method. But meantime, for all your inventory purchase like this, everything is still put under inventory. So then I'll share with you like how to record using a much better method. Okay, perpetual method we come to cover this later on. Okay, but meantime anyway you put everything as inventory. Right, I'll give you more details in a while. Okay, so in this case what you're going to do is that this question says you are going to prepare the journal entry to record the above. Right, do you need to do the T account? If you want, you can. Otherwise, journal entry form, what you have to do is just have date, particulars, and debit and credit. Like that. Very simple. Okay. Just very quickly fill out. If you need to do the T account, please go ahead. Then let me explain to you how to do this. Maybe I give you 3 to 4 minutes to work out first. Then I go through. Okay, so just quickly finish what you can, then I can explain to you more about how to record the inventory. Okay. Can. Your last line, then I can show you a bit about how to do this. Okay. Mainly this one will be affected. One. The other one affected is actually the sale. Okay, let me explain a bit about how you record now. Okay, first thing is that, okay, if you record now and then you record straight to this account called inventory, right? As I mentioned, the problem is that if you buy, you record inventory, you sell, also record inventory. Selling price, cost price, then the account is very messy. It's very hard to understand what is the stock left over, right? So if you have some cost price ones, some selling price, you can't really understand. So what we do is that there are two ways to do the recording. Okay, one way is that we use the periodic method. Periodic method. I make space here. I use the periodic method. Okay, this one is important for exam. Then the other one is the perpetual method. Perpetual method, we'll talk more about it separately. So how the periodic method works is like this, watch. Okay, periodic method. So you have your cash account. Right, so supposedly this is the purchase transaction that you're recording. So January the 8th, you have a purchase transaction. Was it purchase? No, it's a sale transaction on the 8th. Right. So instead of recording in the inventory account, for periodic method, what we do is that we will record this instead in a sales account. This sales account refers to the sale of goods. Right. Any kind of goods. So sales account is actually an income account or revenue account. Okay, so the 500 goes into this thing called the sales account. Whereas in your sales account, you only see one item called cash, 500. And then when it comes to recording your purchases, which is the purchases in this question? Maybe you read. Okay, which one is the purchase transaction? Purchase transaction is actually this one, right? Can you see the purchase transaction? Oh, sorry, use green, or blue. Purchase transaction is actually this one. Can you see this? This is the purchase transaction. Purchase transaction. Can you see this? This is the purchase transaction. So if you use the periodic method to record purchase, only a little bit different. What you do is, in your cash account, Jan 1st, you record purchases 300. Then separately you have another account called purchases account. Now the advantage of recording it like that is that, number one, you can tell clearly how much you buy, how much it costs you to buy, and how much you make from selling. So later on it's easy to compare and tell what is your profit. So like that you can easily tell, oh, your profit must be 200. Right, comparing it side by side like this. Right. Okay, this purchase account is also an expense account. That means assuming that what they buy, everything they also sell in the same month or the same year. Okay, so the sign, plus and minus. So this is called the periodic method. Now the periodic method has certain problems. Certain problems would be like, if I ask you, hey, what happens if 1 quarter not sold? How? You cannot tell, no? Because here it doesn't record like how much is left. You cannot take this one minus this to find out what is left. You can't tell, right? Because all these are in dollar amounts. You don't know whether you have any left. So to know whether you have any left, you must go back and do a stock count. So you need to depend on stock count to find out like how much is left, right, in your warehouse or in your business. Right. So this is one problem. You need to do stock count to find out how much is your leftover stock. Right. If you don't do a stock count, you have no idea how much is left over. Right. Okay, so that's the periodic method. Okay. Now the perpetual method. Okay, we will not really go through in detail today regarding the perpetual method. Perpetual method, what it does is that it, instead of recording in cash account, sales account and purchase account, the perpetual method has one more step. Perpetual method also has a separate inventory account. So this separate inventory account actually tracks how much left. This one will be covering later on. That's the perpetual method. Some businesses will practice the perpetual method, like for example, NTUC. People at NTUC, people at Popular Bookstore, they practice the perpetual method. The reason is because there are large quantities of stocks which they need to track. So then you need to use the perpetual method. Okay? Do we need to know about it for the time being? No need. Right? But what's more important for time being is that you have to know how to apply the periodic method. Now you may say, hey, how I know whether it's periodic method? Okay, it will be stated in the question. Okay? So the question would provide you like, is it periodic or perpetual method? So you just have to read the instruction. Right? So if it's periodic method, then the recording is like this. That means it won't go into inventory account, it goes into either sale or purchase account. Okay, so that's how it works. Right, more details coming up later on, next few weeks' time. So that's this. So recording, how to record? You have to record like that. Okay. Now let's very quickly go through the double entry. Now, although my question now says here prepare the journal entry, but actually, in the exam, they will shorten it to tell you, please write down the journal entry. Right. So that's how the exams work. When you get the revision kit, you can have a look at some of the examples. Normally, they only ask for double entry, not the journal entry. Right. So double entry means write down the debit credit. That's all. Okay. Let's begin with the debit credit for this example. Right, for this example. Right, we use short form JE or the double entry, journal entry or double entry. Let's start from the first one. January the 1st. The double entry for started business with cash. Debit cash, credit, capital, 5,000. Right, narration not required. You don't have to write the narration like, capital used to start business. No need. Okay, you notice that actually I leave a so-called a small little space here. Is it important to leave the space? Not really. Right, yours is multiple choice. You have no choice. Right, when you pick the space would be shown there anyway. Okay. But usually we leave a space anyway, in practice. Okay, the next one. You bought goods are worth 300 and you paid by cash. So if you did the very first method that we went through, then you would have done this. You would have used inventory and credit what? Cash. But you know what? Now I told you that that if you have information about what method to use, like in this case now I tell you periodic method, and what you do is that you simply replace this with purchase. Right, purchase. The next one is the fifth. The fifth is the payment for stationery. So what you do is stationery, cash, and how much is that now? 150. Right, quite easy, straightforward actually. Okay, next one. The 8, sold goods 500. So initially, how you would do is that you use debit cash and credit inventory. Now, what you do is that because I tell you periodic method, then you replace this with sales. So sales, which is 500 and 500. Anything else? There's the 10th. On the 10th you have more items. On the 10th you have bought new furniture 200 and paid by cash. Furniture, cash 200. Right, quite simple. Okay, next one. You bought equipment 1000, you paid by cash. Equipment, so it's 11. Equipment, cash 1000, 1000. The last one is the capital from the owner. On the 21st, there is additional capital from the owner. So it's cash and capital. So the amount in this case is 2000. Like that. Okay, so it's quite simple. Right, if you see in the exam, it'll probably give you maybe 2 items. Right, then you write down, you just choose the correct journal entry. But you won't have such a long double entry question, not possible. Maybe they will give you 1 or 2 transactions, then you write down the double entry. Okay, is there any GST in this question? No GST, but we're coming to the GST. The GST is very simple, right, in a while. Okay, good. Yeah, let's come to this. Right. So in your revision, just make sure that you focus heavily on the accounting entries. Balancing the account. Okay, let's use an example to show how we balance an account. You're not likely to be asked to balance an account, right? But you still need to know how you balance to do some of the more tricky questions. Okay, we use the example on page 28 to demonstrate how we do account closing. Right. Okay, let's start with capital account. Now, how we close the account now is that we'll do this thing called balancing. There's this step called balancing. What do you mean by balance? Now, if you observe in this case, on the right, how much you have? 7,000. So the right side is greater than the left side by 7,000. To balance the account, you need another amount here so that both sides are equal. And the amount that you need here is 7,000. So this is what I mean by balancing the account. Right? Okay, so that both sides are going to add up to be 7,000. The same on both sides. Okay, so you get the idea, quite simple. Right, so that's the same both sides. Okay, then this one, when we close the account or balance the account, usually this takes place on the end of month. Usually, okay. However, for purpose of exam, you don't need to know is it end of month or end of whichever. Not so very important. But typically, it must be end of month. Normally, Okay, and what is this one? Balance. Carry it down. We call this balance carry down. So this is to bring the balance into the next month. So next month what you have is that you continue to the next month, which is February the 1st. When you bring over to the next month, you always start with the first day of the month. Always first day. So then the next month your brought down begins with 7,000. Okay, you need to do this T account for something else. So make sure that you have your figures here. We will do something important with it later on. Okay, let's write down the brought down. Okay, next one. Cash, how to do? Cash actually the same. What you need to do is that you need to find out what is the closing balance. How you do it? Quite easy. Okay. Left side now you add up gives you about 7,005. Right, left side. 7,005. So the right side now actually is not 7,005. The right side is actually lesser. How much lesser? Let's just do a very quick calculation. So you take 7,005 minus 300, 150, minus 200, minus 1,000. You find that actually you need another 5850 so that both sides of the account are equal. Right, so this is called balancing also. Okay, what do you call this 5850? 5850 therefore is known as the balance carried down. Right, carried down, CD, carried down. So then you carry down to next month, which is February the 1st. Now, very important rule is that when you bring down, remember when you bring down, the carry down and the brought down is always opposite. Okay, so just remember that. Bear in mind, the carry down and the brought down are always opposites. Right, so if the carry down is on the left, then the brought down will come to the right. If your carry down is on the right, then when you continue the next one, it goes to the left side. Okay, so it's a rule. Okay, that's this. Can you have no balance? Can. But some questions don't have any balance. Okay, so you see that? From right, go to left. Okay, right, go to left. Okay, next one. How about inventory? Okay, so for this case, we also can do for this inventory account. How you do it? Quite simple. It's actually the same thing. Right, you got 5. Left, you got 3. So to balance the account, you need another 200. Right, so this is at 31st, and this is balance carried down. 500 and 500. So bring down to next month, and that's February the 1st, 200, like that. Okay, just make sure you will have the same balances which you will be using in a while. Stationery, how to go about stationery, you see, left you got 150, then right you need another 50 to balance. Right, so you get the idea. Now the closing must always be at month end. Always. Always must be month end. So then this is balance carried down. Okay, but for your purpose, since you don't really have to do it in the exam, you don't really have to do the T account in the exam, you can use short form. Okay. Okay, then both sides are actually equal. Then you bring down to the next month. Balance brought down 150. Okay, last of all, then two more items. Then there is furniture, which you have to balance also. Right, so that means if you have like 50 accounts, then you must do this for all accounts. Right. Okay, on paper. Okay. However, you won't have this many accounts in your exam. You won't see like 10, 20 accounts. Not that many. Balance, carry it down 200, and then you bring down February 1st, balance brought down 200. Okay, and repeat the same for the last one for equipment. For equipment, do the same. Carry it down, and finally bring down, and which gives you also 1000. Okay, so quite simple, but we will be using this number in a while for something else, very important. Right, we are going to use this number for something. Okay, good. Okay, so far so good, huh? Do we need to do this? Do you think that you need to do this for exam? Not likely, but you need to use it for some other working now. Okay, so that's closing. Okay, so you have done the closing. Let me ask you to do maybe one other closing just for your information. Remember just now we were at page 27, so maybe just try closing for these two accounts. Just make sure they're comfortable for inventory and payable. Right, so you get the idea how you do it now. Right, so like inventory, how do you balance it? Okay, give it a try. Same for payable. Just give it a quick try. Then we can move on to the next item. Here, just 3 more things, then we call for break already. Okay, good. So let's just quickly see how we balance. So inventory, when you try to balance, it gives you 550, but there is no date. Balance, carry it down. Then you do the total, left and right. Bring down your balance. Brought down 550. Okay, do the same for the payable account. Same thing. 4,002 to balance the account. No date. Balance carried down 4,002. Here also 4,002, and what you need to do finally is bring down the balance. Right, quite easy. So the balance you compute first, then after that you bring down to the opposite side the next month. Okay, so that's how it works. Okay, so next thing. Okay, so we actually have managed to finish most of the stuff. And we come to actually this thing called a trial balance. The trial balance is quite simple. Remember I told you to do this? Right. You see, you remember this thing? Why you have all this like brought down? What's the purpose of it? This brought down can do something very important. They help you to prepare a item called a trial balance. A trial balance is quite a very interesting item. The purpose of it is to help you to do a few things. Firstly is to help you check for mistakes. Right. Check for mistakes and especially accuracy. Right, so that's why we have this thing called a trial balance. Right. If not, imagine if you have like 100 over accounts, how do you check for mistakes? The trial balance is one of those ways that we use to check for mistakes. Right, one of the ways we use to check for mistakes. Now, however, the trial balance is not a perfect tool to check for mistakes. Right? But before we start to see like how it helps you check for mistakes, let's see how we prepare a trial balance. A trial balance, the format are quite simple. It comes with a header. The header very simple, is trial balance, asset, and the date, right, day, month, year. It has two very important columns, a debit and credit column, followed by the 5 category of accounts. What are the 5 category? Asset, liability, equity, income, and expenses. So once you fill out all this, supposedly, once you have done it correctly, the total of both debit and credit should be equal. They should be equal if you do it correctly. Simple. Okay, we will just use one example to demonstrate how this is done. Then you can go for a break. Then later on when you come back, we're going to do another 1-2 example just to let you see how we do it. Okay. Right. Okay, let's come to. Okay, so how's the steps? First, you must have the heading. 2 is that you list out the account balance. And 3 are very easy. It's just show the total like that. Okay, very simple process. Let's have a look at how we do it. Can we see how it's done? Okay, we used the earlier example. Remember just now that page? I flashback. Flashback. Right, so this one we did all the balancing correct. So now we are going to use this balancing, all these balances to prepare our trial balance. With all these numbers, right, all those numbers. The brought down. Okay, so basically, if you want, you can use you can highlight what numbers you use. The numbers you use to form the trial balance will be like the brought down from capital, and what else? Brought down for cash. The other one, brought down for inventory, stationery, furniture, equipment, everything that you can find. So you gather them. Okay, so we are ready to do the trial balance. Okay, let's try to do the trial balance. Let's start with the heading. If you're asked to do, you'll be told like what date is it. My example is just month end, 31st January. Okay, so you have this. Okay, you start with the header. After that, you list out the account balance. Okay, let's try to do the account balance now. Okay, let's start from the first one. Capital, how much? 7,000. Capital is 7,000. Which side is it? It's on the credit side. Okay, so you just have to copy and transfer over. Easy, Okay, next one. Okay, next one, So next one, what is the next one? Next one is cash, Cash, how much, 5850 on the debit side. So we do the same, Cash 5850. Okay. 5850. Okay, next one. Okay, done. Inventory, how much? 200. Well, you know something, because this is the old method of doing. If you use this, also can. Okay, I'm going to show you like what happens if you use this. Okay, but meantime, we use the old method first. Just let you show you that whichever one you use, the trial balance would have very little impact. Should not have any big impact. Okay, 200 okay, let's fill up 200 here. Inventory. And the inventory that you see here has 200. And the 200 is on the credit side. Easy, not too bad. Okay, next one. Stationery, how much are 150 on the debit? Stationery, 150. Right. Okay, not too difficult still, Next one is the furniture, 200. Anything else? Last of all is the equipment, which is 1000. And what about this? So it's 200. Okay, once you're happy with that, you add up. When you add up, what do you see? When you add up, you should find that actually both of them, both sides are the same. Right, which means that you have done it correctly. Right. So it's a very easy process to do this. But however, in your exam, they are not going to ask you please do trial balance just like that. It's not like that, so easy. Okay, doing it is quite straightforward. Okay. Right, so that's this. And then now what we'll do is that we're going to call for a short break. But we're going to try another one. This other one, you try on your own to see how it's done, trial balance. Okay. Then you can just take your time to have a look at it. Okay, the other trial balance that you're going to try, the other trial balance, okay, we did this already. Okay, do you remember this one? This one is on page 25. Your job is that you're going to look at page 25. We already did the T account. And you're going to prepare trial balance using these T accounts that we have prepared. But you know what? These T accounts have missing balances. So you need to prepare the balances, then you can start to do the trial balance. Right? So I'm going to let you have your time to give it a try. And then later after the break we'll have a look at this. So take your time to do this. And you can have your short break of 15-20 minutes if you need this. Right, so you can have a break and then you can think about doing this. So your first part is make sure you do a balance. If you don't do a balance, you cannot start with the question. Okay? Do this first. Then you can start the trial balance. Okay, you have your break and then I'll see you shortly in 15 to 20 minutes time. You did this before. Okay. So we resume shortly. Hold on. Yeah. Oh. Okay, I ask Kasim. I ask Kasim. Let me ask Kasim. Yeah. Okay, let's go at this. So, okay, let's commence with this. Yeah, so let's have a quick walkthrough on the closing balance. You need the closing balance in order to do the very important thing, which is the trial balance. Okay, so you must close, then you can do trial balance. Let's start. Asset 2,500. So then your closing is 1,005. If you want, you can do in red now. Do in red. And here 2,000. So usually, as I told you just now, usually the closing is at end of the month. Usually, and once you're done, bring over to the next month, and you are done. 1,005. Okay, not too bad, huh? Okay, next one, cash. So you have 2,100 on the left, you have 50 and 80 on the right. So the closing balance is therefore 1970. Sorry, 1970. So that is the closing balance. Okay, good. So it gives you 2,100, and after that you bring over to February the 1st. Balance brought down 1970. Okay, easy, so far so good. Okay, receivable 100. So then to balance you need 100. 31st of January, balance carried down, and then you bring down 1st of February, balance brought down 100, and done. Easy. Okay, let's come to the next set of the next account. Okay, rental, do the same. Rental 31st Jan, brought down, sorry, not brought down, carried down 1,000. And what do you need to do next? Bring over 1st of Feb, balance brought down 1,000. Okay, getting very simple. The bank repeat the same. Determine what is your closing balance, 31st. So now your closing should be 1,001, 1,005 total, left and right. And then you bring down to the next month. 1st of February, balance brought down 1,100. Okay. Drawings, likewise, same thing. 31st Jan, carried down, and then after that what? Bring down to the next day, and the next day is 1st of Feb, brought down 50, and capital here same thing, 400, carried down 31st of January. Okay, so then your closing balance you bring down. So 1st of Feb you have balance brought down 400. Okay, not too bad. I think so far so good. It's not too complicated. Okay, payable 80. 31st of Jan, balance carried down. And what else? 1st of Feb, balance brought down 80. Can. So you should have been able to do this, no problem. I think quite easy to do the closing balance. Once you have obtained the closing balance, then the next thing to do is that you have to prepare your trial balance. Your trial balance, very important, you must have the heading, right, which in your exam not likely they will ask you to prepare trial balance. But we need to know this for something else. Okay, that will be like, I think, another few more lessons time. Okay, how you prepare this? Okay, let's start to fill up the numbers. Okay, there is actually no sequence. You can start with any account. So we start from inventory, the first one. Yep, you're right. Easy, not too bad. Okay, next one is cash 1970. Okay, easy, So you just have to basically transplant the numbers over. Receivable 100. Receivable 100. Easy, So basically just copy and paste over. Okay, going on. Okay, so let's see what's the next account. The next account is rental. Rental 1000. Rental 1000. Bank 1001. 1001. What else? Capital. And then there is drawing. So drawing is 50. Drawings 50. Okay, 50. What else? Capital 400. Capital 400. Not too bad, actually. Right. Payable, how much? 80. When you are done with it, then once you are happy with what you have prepared, then what you do is just add up. Add up and confirm whether it's equal on both sides. Does it equal on both sides? Oh yeah, receivable, right? Okay, anything? Yeah, does it equal now? Yeah, how much is the total? 3,000, Okay, 3,001 on both sides. Can. So it's like that, just like that. Can. Now, so next question to ask. The moment you find that they are equal, it shows you one thing, that is, should not have mistakes. Right? There shouldn't be any mistakes. At least no mistakes with calculation. Shouldn't have. You shouldn't have mistakes with calculation. The calculation should be accurate. Should be. But you know something, however, trial balance has one problem. Still can have mistakes. Now, what kind of mistakes could still occur? This will be covered under another topic. Right, we'll come to this. And this one is important for exam. Take note, important for exam. Right. Otherwise, when you find the trial balance is equal on both sides, there should be no mistakes, other than some other mistakes which are coming to it later on. Okay. Okay, so we went through the trial balance, and let's come to the lecture notes on the trial balance notes. Page 30. Page 30. Page 30. Right, so some theory that you need to know. Right, so what is a trial balance actually? A trial balance basically is a list of account balance. Right, it's a list of account balance. And we use this to check for calculation. Arithmetical accuracy, simple English, we say that we check for casting or otherwise check for calculation. Right. Do you need to know the term casting? No need. Right. Now some of you may have came across the term casting. Casting means that you add up and check. Right. So these are the two main reasons why we have a trial balance. Right. And because you have these two things, it allows you to do other things like prepare your statement of profit or loss, P&L, and you are able to also prepare one more thing called statement of financial position, which is the balance sheet. And you could also use the trial balance to help you prepare the cash flow statement. So it's very useful. It allows you to prepare all these things. Okay, since we have covered the preparing of the ledger account, okay, so we went through how to prepare a trial balance, right? Simple. Why do we prepare trial balance? These are the reasons why. Right, it's to list out account balances, and the other is to help you check for mistakes. Same thing here. Now there is one more reason why we prepare the trial balance, is to ensure that double entry rule has been consistently applied. That means when you got debit, you also got credit for all the transactions. Right. So it's to confirm that double entry has been applied. But you know what? In today's world, if you use your MYOB, QuickBook, right, and maybe things like Navision, you know that so long as you use accounting software, whichever one you use, automatically they will make sure that you have double entry. Right? It's only last time. Last time, everything is on paper, so you may not have double entry. But now with accounting packages, you always have double entry. Right? So is this important today? Actually not so important already, but you know what? In your exam it's still important. Right? It's still important. But last time it's very important to do the trial balance to check. But now with MLB and QuickBook and so on, it's very easy to check. Okay? And in fact, you shouldn't have problems with double entry. It's always, you always have debit and credit. Now, the question then is that, or the issue then is that, but can pose wrongly still. In other words, wrong account. Right, even though the double entry rule can be consistently applied, that means everything you got debit and credit, but you still can have mistakes like, suppose be paid by Mr. Tan but you recorded as Mr. Lee. Suppose be payment for rental but you recorded as payment for stationery. So such problems can still arise. Okay, we'll come to talk about this in more detail also in another topic. Okay. Yes, and we use this trial balance to prepare the profit and loss, statement of financial position, the balance sheet, and finally the cash flow statement. Right. Okay, we went through an example of this, so it's not important. We just went through. Right. 2. Any self-test question to do? No self-test. Okay, and you have completed this part for today. Right, not too bad. Okay, we come to the next part of today, which is the basic financial statements. We'll go through some simple examples. Right, your revision kit actually has more complicated ones. Right, the moment you get a revision kit, then we go through the more difficult ones. Okay, so in your exams, you are expected to know how to prepare this thing called the balance sheet. Have you all taken the computerized exam before? If you did, how they test this is that you have the table, then you click on the correct option. Right, if you have done it before. Right, so first one is the statement of financial position, which is tested in exams. This is tested. The next one is the profit and loss. Okay, you will need to know how we prepare this. And these are the two main things. The two main things that we'll be going through. Okay, let's have a look. Statement of financial position. Okay, a statement of financial position basically shows three very important groups of items. Mainly they are the assets, liabilities, and not forgetting, very important, is the equity. Right? So it shows these three groups of items. So these three groups of items they are all related by the accounting equation. Accounting equation says that if you take assets, this amount should be equals to liabilities plus equity. They should be the same, right? And when we prepare the balance sheet, we also apply the business entity convention. What does it mean? It means that the assets that you see here belongs to business and not owner. If the owner has a private apartment for his own stay, that one is not asset of business. If the owner has some spare cash that he used to invest in stock market, that is his own business, his own problem. Okay? So we apply this entity concept that what belongs to business is not the same as what the owner has. They're different. And what the business owes, this is owing only by who? The business, and not the owner. Right? So if the owner had credit card bills that he has not paid, is it the liability of business? It is not. Right? If the owner had mortgages that he's paying for HDB, then one is not liability of the business, it's the owner's own liability. Okay? Important to know this? Not really for information. But you know what? Please take note of what we mean by the business entity concept. So this concept simply means that what belongs to business doesn't belong to the owner. Right? The owner and business are considered as separate. Okay? They are not the same thing. Okay, let's come to the next point. Okay, in the old days we refer to balance sheet as balance sheet, but then in modern times or in even your exams, the term we use is statement of financial position. So that's the term that we use these days, right? It's not different, it's actually the same thing. Okay. How do you prepare a balance sheet? A balance sheet basically comprises of about the three main segments. Okay, let's just have it written here. Important thing is that you must have the heading. They may test you this under section B. Statement of financial position, and this is at 1st Jan 14. Okay? It goes like that, so it starts from non-current assets, then you go on to current assets, and once you are done with that, then you continue to equity and liabilities. Liabilities, there are many, so you can have non-current and current, and maybe current. This one in the exam, if you do see it, it will probably be falling under section B, the long question or the short question. Right? If you get tested, it will be under section B. Just have to make sure that you understand the arrangement, right? And ensure that you correctly arrange all the items. That should be fine. Okay. Let's have a look at how we fill in the blanks. You could do it in what format? Two-column format. Okay, so start from the non-current assets. Now you have equipment and furniture. Now in practice what we do is that even in the exam is that we add them up and we classify them as property, plant and equipment. We actually group them together. Right. So therefore your non-current asset only has one line. Property, plant and equipment. So that gives you in total 4 plus 6, which gives you 1,000. Right, so that's how it goes. Right. In your exam, you have to classify them together. Okay, do not need to show separately. Okay. Current assets, you have your inventory, cash. So you just have to fill up here. Inventory and cash. Now, inventory and cash, you don't have to separate. Rather, you don't have to add together. You have to make sure that you show them separately. Inventory, cash. Inventory 900, cash 100. Add up, that gives you 1,000. Okay, quite easy, huh? Once you are done, add them up again together, then that gives you 2,000. Right. Now, however, in my question, I didn't give you the equity. The equity is not clearly given to you. Right. So actually, there should be under equity this thing called capital. I didn't give you the capital, so this capital is actually unknown number. Right. There's no number to it. Is there a number? There's no number to it. So how you can calculate this missing capital is that you can take asset minus liability. So you would still be able to find out how much the capital is. Okay. After that, now fill up the loan from bank. Loan from bank is 350. Yeah. Loan from bank. Okay, loan from bank. You can assume that it's non-current. You don't really need to mention that it's from bank. You can leave it as loan. So the loan is 350. Which means that the missing capital must be 1650. The remaining is just simply 2,000. Just like that. So it's a very simple layout. You have your assets. Right, you have your assets on top, and then you also have your capital, and then after that you have your liabilities. Right, so it's 3 categories of items. Right, asset, capital, and liabilities. The examples that they will give you are probably not going to be very complicated. It will be quite simple. Probably something like what you see here. Maybe with more details, but not very difficult. Right? Won't be very, very difficult. But very important is that when you prepare this, you have to make sure that your balance sheet or statement of financial position must balance out. Okay? 2,000, 2,000. Ensure that they balance. Okay. Just telling you like that not good enough. We will do one example just to show you like how it works. Okay. Right, so here we have a slightly more complicated example, which I'll give you time to try doing this. Right, and you know what term we refer to balance sheet as? We no longer call it balance sheet, but in your exam, the term that we use is statement of financial position. But still, in some books, you still find the term balance sheet. They mean the same, no difference. Okay, let me give you some time of how much time? Maybe like 3 minutes or so, 3-4 minutes. Just prepare your own balance sheet. Right. Don't forget, must have heading.
Okay. Okay, you're all finishing.
Okay. Should be finishing. Okay, good. Okay, can I just tell you a bit about this? Can. Okay, can. So notice that we actually divide assets into two groups. Although these two groups are assets, but the way we divide it is quite special. How we divide this, just to give you more information on this, is that it's according to how long. How long you think you will keep the asset. When you look at property, equipment, these are easily more than 12 months. Right? The building, the office that you use, easily you'll be using it for more than 12 months. Right? So it wouldn't be like, now you use and later on you dispose in a year. Right? You're very likely to be using it for more than 1 year, 2 years, 3 years or longer. Right? So such assets which you intend to use for a very long period of time, these are known as non-current assets. In the old days, we sometimes call this fixed assets. In the old days, but for purpose of exam, it's called non-current assets. This category of assets that you see below, these are a bit different. How different are they? They are different because you don't think you'll be holding them for more than 12 months. Like things like inventory, would you hold your stocks for more than 12 months? You wouldn't. Your stocks would probably be sold in a month or two. Right? So stocks are not likely to be held for more than 1 month. How about cash? Cash is for purpose of making payments. You're not likely to be holding your cash for more than a year. You'll probably be using it for payments whenever you need to pay. Receivables as well. Your customers owe you money. They'll probably be paying you in a year's time. They shouldn't take more than a year to pay out. Right? So that's this. That's how we classify. We use the 12 months as a guide. Okay. But for your purpose in exam, the current assets is always inventory, cash, and receivable. Always. Right? Always. Okay. Then moving on, what you do is that this column here is actually for the details. So you list out the details, and after that you add up to get the grand total. So the grand total you add to non-current asset, that gives you the total assets. Okay, so that's the idea. So when you add up, that gives you the total assets. That's how it works. Simple? Okay, good. Okay, next one is capital. Again, in this question, the capital is unknown. Since it's unknown, then you will need to find it out on your own. How do you find the missing capital? Right? Yes, you're right. So you take A minus L. Asset minus liability, that gives you capital. Okay, that's one way to find it. Okay, so if you do that, you would find that you have, how much is that? So you take total assets and you minus against your liabilities. So in this case, there are only two liabilities. There is the payable and there is also the mortgage. So you find that in this case, your capital should be 35500. Do you have that? 35500. Now you may get questions where they may ask you, calculate capital. Right? So which is quite simple. Okay, multiple choice. Okay, mortgage. Can you know where's mortgage? Mortgage is here. Mortgage is below. Mortgage is 35,000. Now next question. How do we know that mortgage is non-current? When you say non-current, it means that it's something that you have to pay in more than 12 months time. Mortgage typically you pay over how long? Typically you pay over a period of 10 years, 20, 30 years. So this one will qualify as mortgage. Now current liabilities refers to those that you have to pay out in less than 12 months. Such current liabilities would be like money that you owe your suppliers. So if you owe a supplier 2005, you would think that you have to pay him in a year's time, right? 1 year's time. Okay, once you're done, sum up, and that's about it. Sum up, right? So that gives you also 3,000. So in this case, the balance sheet balances, or the statement of financial position balances. We actually have a line here saying that this 73,000 refers to total equity and liabilities. You probably don't need to write this in the exam. That's about it. Quite simple. Right? It's very useful to people reading the statements because it tells people how much the business owes, and that's very important. Right? You do not want to purchase a business that is owing lots of money, right? And the other thing is, you want to look at what the business owns, right? Is that good enough? Actually, you know what? Like that, not good enough. You want to look one more level. That is, other than what they owe, you want to look at how much is their interest cost. Right? That's also important. Right? Some businesses have very high interest costs. So if they borrow a lot, okay, fine. But then if the interest cost is also a lot, then that's quite worrying, right? Some businesses have very high interest costs. One of the highest interest costs I ever heard of is 24%. Now, who will charge this interest rate? They are not called alongs. There are such people. You can find them online. They're called Mullah Sense. Right? Mullah Sense is crowdfunding. It's actually a type of platform to borrow money. It's not in the syllabus. Right? In your syllabus, there is no crowdfunding. But then some of you work in those high-tech companies. Or maybe you work in companies where bosses open to ideas, then they will use crowdfunding. Right? Crowdfunding is a way of borrowing money. And Mullah Sense charge as cheap as 9%. The interests are all like that. You know why? Because what they do, the scheme is that they get money from investors. Right? They get the money from investors, and what they do is that they mark up the interest. After they mark up the interest, they lend it to people, whoever they are. They lend to other businesses. Right? So if let's say they charge these guys 9%, they may take 1% and they may return the 8% to the other investors. So that's crowdfunding, right? Or crowd lending. Right? Recently there was this very interesting one. Do you read newspapers? Can guess. I also don't read newspapers. But this one was interesting. Like Epicenter recently they borrowed through Mullah Sense. They borrowed at interest cost of 13.5% per annum. 13.5%. Very expensive. Right. Okay, so looking at what the business owe is one thing. You also want to maybe look at how much is the interest cost. Right. Okay. We will come to this thing which is ratios later on. So ratios you can look at whether the interest cost seems too high or too low. So that's later on. Okay. Right, so that's the balance sheet. Important, very important, more for the section B of your exams. Very important. Right. Okay, so we are done with this for now, and we come to more details here. So basically, we classify assets into two broad categories: current and non-current. Right, which you already noticed are grouped according to current and non-current. So current assets, did I mention here? No, I didn't really mention here. Right. So basically, assets are divided into two categories. One is the current assets. Current assets are those that you don't intend to hold for more than 12 months. Within 12 months, you get rid of them. What are examples of such current assets? They can be like inventory, which you saw just now, or they can be stuff like cash. They can also be things like receivables. All these are not expected to last more than 12 months. However, non-current assets would be those that you intend to use for more than 12 months. Typically, such items include property, plant, and equipment. Typically includes these three things. Right, of course you may say, what about furniture? Furniture also, right, furniture. But you know what, we group furniture as part of plant property equipment, or property plant equipment. Right, so two categories of assets. Okay, in your exam we always will separate into these two categories. Okay, whereas for liabilities, we group into two categories. Those that you intend to pay in 12 months, and those that you won't be paying in 12 months time. You may be paying like over 1 year or 2 years, 3 years time, right? Maybe 10 years time. So examples of non-current liabilities include your mortgage, your bank term loan, right? Whereas those that is lesser than 1 year would be like your overdraft. Now overdraft is considered as current liability. Payables. And depending, may also have term loan. Because term loan can be half year, can be 1 year, can be 2-3 years. Right? So term loan can be short term, can also be non-current. Just be watch for that. Okay, so that's this. Do you need to rewrite the earlier balance sheet? No need, because we already have broken down according to current, non-current. Okay, so that's done. Okay. Okay, one more thing. This payable, does it have to refer to only goods? Is it only goods? Not necessary. Can also be for services. Can be for services. Like for example, your phone bill that you have not paid, company phone bill. For example, rental expenses not paid. Those are all payables. Right. Your services that are not yet paid, all these are considered as payables. Okay, one more thing. What happens if you have rental deposit? Or you have whatever deposit that you put with your landlord or maybe with the bank. This deposit that you put with the landlord or the bank, this deposit is part of your current assets. Okay. But some people will say that, hey, my deposit is for 3 years. But you know what, in exam we always assume your deposit is less than 1 year. Right, in exams. Okay, but deposits of course can be for many years. Okay, so that's this. Right. Okay. Will they ask you this in the exam? Okay, not directly, but in another form. Okay. Okay, I'd like to explain to you one more thing very interesting. And I think it's very important to understand this. For example, today, this is your year 2015, and your year end on 31st December. And this is the year 2016. And this is the year, one more, and this is the year 2017. Okay. Let me ask you this. Let's say on 31st December, you have a loan for 12,000. And you have 24 months to pay back. Okay? No interest, No interest. Okay, question. On this date, in your balance sheet, how much would be your current liability and non-current liability? Should it be in total, non-current liability 24,000 cannot be. Right, because if this one is every month you pay, then it changes the story a bit. Right, why? Let's observe. 12,000 you got 24 months, how much do you pay every month? So 12k over 24, that gives you 500. Do you believe me? You believe me? 500 per month. Right. So for the following 12 months, how much will you be paying? 500 times 12. So 500 times 12 is considered current liability. $6,000. Then how about the other portion? How about this portion? How about this part? This part how? This part you have another 12 months to pay. So what happens here is that this 500 times 12 is after 12 months from the balance sheet date, more than 12 months later. So this part becomes non-current liability. This part is non-current liability because it's beyond 12 months. So then in this case, how much is the non-current liability? Also 6,000. So beware, the same loan can be both current and non-current depending. Right? Can be both at the same time. You may get it in MCQ, so they may test you MCQ. Okay, now I change the story a bit. I change this. Let's say now I tell you, good news. The loan pay lump sum when in 2017. Does it change the numbers here for current and non-current liabilities? It will change. Because if let's say now the loan is like this, you got loan 12,000, but you only pay in 2017 lump sum. That means you're not going to have this 500 times 12, you're not going to have this 500 times 12. Instead, you have one lump sum which is 12k. Right? And then your current liability is now 0, and now your non-current liability is 12k. Right? So you have to be careful of the terms. Is it every month pay? If every month pay, then it can be, you will have a current and non-current portion. You know what? In the exam, if you do see it, you're not sure, just toss 2 coins. Right? Take 2 coins and toss. Right? Toss until you get the answer. Right? Okay, so this is just be careful because a loan can be current and also non-current at the same time. Can be both. So that's this one. Okay, but it's not very important. It's only 2 marks anyway. If you see it, 2 marks only. Right, 100 minus 2 marks, you still pass anyway. Right, you still get 98. Okay, this one not very important, but let's. So you know what's the point? The point is that a loan can be current and non-current at the same time. That's why those of you who do GL, how do you determine the current and non-current? If you do full set accounts, what you do is that you look at the loan schedule, right? So based on loan schedule, you calculate. Right? The loan schedule will show you like how many to be paid this year, how many is actually next year. Right? Loan schedule. Right? Okay, will we give you a loan schedule in the exam? Don't have. Okay, but in practice, we actually look at the loan schedule and we calculate. Okay. Next one. Okay, next thing, good. So equity, so far we have seen is that it comprises of capital from the owner, mainly from the owner. But it also can include profits and losses from running the business. But if you make money, it's your money. If you lose money, that's your money that you're losing, right? Of course, the business owner can have the choice of withdrawing money for own use. Right, for own use. Like taking goods for own use or taking money for own use, these are drawings. And these fall under equity. Take note, drawings is not expense, they are not. Right? This one is owner taking for own use. It's not expense. Do you need to know about partnership? No need, it's not important for exams. However, for limited liability company, equity is made up of share cap and reserves. Right? We come to this thing in detail later on. For purpose of exam, sole proprietor not important. For purpose of exam, limited liability company is the most important. Right, but if you want to know like, sole proprietor, you want to know more details about it, you can ask separately. Else, this is the focus for your exams. Limited liability company. Okay. And in general, the statement of financial position for sole proprietor and partnership are very much the same. But is it important for exam? Not important. Right. Okay, let's come to limited liability company. Okay, I'm almost done for the day. I just need to go through with you some details, then we're done. Okay, so let's come to this part, C. Okay. Okay, let's come to this. Okay, I use sole proprietor as a reference. For sole proprietor, what is the equity of a sole proprietor? Basically includes number one, owner, capital, and any profit or loss. And after that, any drawings. So therefore, the equity later on is 1 plus 2 minus 3. So that's for sole proprietor. Now for limited liability company, it is very similar. Right? How similar is it? Okay, let's put it side by side and we compare. For limited liability company, For limited liability company, what is so different about it is that it has many who are owners. Yes, correct. The owners are equal to shareholders. You can have many shareholders. Right, so many. Right. You have many shareholders. However, for sole proprietor, it's only one owner, and you call him owner, or you call him the sole proprietor, right? One person. So the equity of limited liability company is actually very similar to sole proprietor, except that instead of the money coming from one person provide capital. Now is many people provide capital, and the capital that these shareholders provide is called. Okay, there is also equity. The capital that they provide is called share capital. You know why we call it share capital? You understand why? No? Because these people, they have a share in the company. That's why we call them shareholders. They have a share of the company. And the capital that they provide is share capital. Okay, good. Now, a limited liability company is like a normal sole proprietor. Same. It also makes profits. Right? And then from the profits, it has to pay dividend to the shareholders, right? So therefore, this one, this number that you see here, is actually known as the reserves of a limited liability company, right? Reserves of the limited liability company includes profits minus dividends paid. Profits minus dividends paid actually has a name to it. That name we call it retained earnings. Or some people refer to it as retained profits. And what is retained earning or retained profit? Is simply referring to net profit minus dividend. Right. retained earning. It can also include current year or prior year. Can, no? Like last year, you never finished paying out all the profit as dividends, so then it gets rolled forward. Okay, can roll forward. Reserves, there are many, but for purpose of the syllabus, retained earnings is the most important one. Right? There are some other reserves, we come to it later on. Right? Another reserve is actually general reserve. Okay? More details later on. That's all to it. So then the equity of a company is actually 1 plus 2. There is no drawings. No drawings. Then how do shareholders get their money back? Through dividends. Right. So there is no such thing as shareholder take goods for own use. Dividends are paid to shareholders. So they are actually very similar, no? If you compare them side by side. Very, very similar. Right. Okay? So we come to, okay, so these are the two main reserves of a limited liability company, the most important reserves. Let's come to the notes again. Okay, good. So there are many types of reserves. The main one would be retained earnings, and the other one is the general reserve. Now you may say, what do you use this reserves for? This reserves got many uses. One of the uses is that we use it to pay dividends. The other is that we may use it to issue bonus, or if you like a simpler word for it, free shares. Like instead of giving cash dividends, the company may say, okay, we want to reward shareholders, so the company issues new shares for free. And these free shares are paid using company reserves. Okay? There is also share premium, which you will need to know what it is. Revaluation reserve also need to know what it is, but you know what? We come to cover all this in a separate topic. Okay? The simpler ones is actually retained earnings. That's the most important one. General reserve actually is. Now, how does general reserve come about? Is like that. Okay, let me just tell you how it works. Say, for example, the example not important to you. It's just to explain to you how it works. Okay, you do not need to like remember how to draw. Okay. Let's say the profit this year is 100. Okay. What the company may say is that, oh, we got 100. Can we do this? We take out a portion of it and put under this thing called general reserve. So then we put here maybe $20. Right, so you allocate out. The next year, what happens is that the company continued to be profitable. The company next year was able to make profits of, sorry, why did I use this color? Okay, company made profits of $120 here, 120. So what the company may say is that they may say, hey, I got excess profit. What I do is that I take out a portion of it, then set aside. Maybe set aside another $20, so you have $40. So this reserve you can put one side. And the reason why you may put one side is because they thought you could use this to issue new shares. Or you can use this to buy back shares. Right. Do you need to know all this? Later on we'll talk more about it. Okay, so that's why you have general reserve. Right. And this is retained earnings. Actually the screen not bad. But I think Somerset has better screen. Right. Okay, so that's this. Do you need to know how to draw? No need. Right. So in a limited liability company, how they present the equity is that only two things: share cap and retaining, just like that. Okay, we have some time to talk about the share cap of a company. And then later on, I think this following example I will cover with you separately on the following lesson. But I'd like to explain to you about the share cap now. I think it's important to know how this share cap works. And then after that we can finish for the day. But what I'm going to explain to you is not so important for the exams. Right, but it's important for you to know if you do prepare the full set of accounts, or if you're trying to understand a company, it's important to know this. Now there are many categories of shares in a stock market, right? But for your syllabus, shares are broadly divided into two types. Right. The first one is what we call ordinary shares. The second one is not called special. Second one is called preference. In Singapore stock market, companies may issue both ordinary and preference shares. It depends on the company, right? Now some companies they not only have two categories of shares, they may have category 1, ordinary share A, and then maybe category 2, ordinary share B. So they have different special category of shares. But for your purpose, you don't need to know all the special category, right? Shares are mainly divided into two categories, ordinary and preference. Okay, let's start with ordinary share. Ordinary shares in American language, they call it common stock. Right, the term common stock doesn't mean easy to find. Right, it doesn't mean easy to find. Right, it doesn't mean common, that kind of common. Okay, but it's just an American name. Okay, they call it common stock. But in your exams, you refer to this as ordinary. Now, what's so special about ordinary shares? Ordinary shares work like that. Let's say in my company has capital of 100. How do I split between two owners, A and B? How do I split? Okay, one way that you can split between the two owners is that you can say, why not like that? We cut the company into two. We cut the company into two. So that means one share equals to 50. So then the owners owner A can have one share, B can have one share, and then each of them their share is worth $50 each. So then the total amount that they own in the company is $50 each. Right? And they have equal rights to make decisions because he got 50%, also got 50%. They have equal rights to vote. And you can actually increase the number of shares, If you increase the number of shares, so it can go like that. The price per share can drop to lower. The value per share can drop lower. How come? Because there are more shares. With more shares, it reduces the value per share. Okay. So A may have, like in this case, 50 share and 50 share. So in this case, if it's 100 share, then each share is $1. Right? And their total investment in the company is actually $50. Each person 50 each. Right? And they have equal rights to make decisions. Equal rights. Okay, why do they have equal rights? Because every ordinary share gives them this thing called voting rights. The right to vote, make decisions. Right. Voting rights is very important during AGM, during the annual shareholder general meeting. So you may have to vote like, do you agree with the proposal from directors like to increase director fee or adjust director salary, whatever it is. Right. So ordinary shareholders, with every one share, they have voting rights. Right. However, preference shares, they are different. They don't have voting rights. Okay, then you may say, hey, then why people want to invest in preference shares? Okay, that one not important for exam. I will tell you about it separately. Right, so that's the difference between these two. Okay. Now then you may say, wow, so troublesome. Why got share like that? Now the interesting thing about shares is that you can transfer ownership. Let's say B say, hey, I think I enough already. I don't want to work too many years. B can reduce his holding and pass over his shares to another person. So the ownership can be transferred like that. When you're tired, you think enough, you can transfer shares to another person easily. Do you have to go to a law firm to do the transfer? No need. Right? It's very convenient. Right? You don't have to go to law firm and then fill up many forms. Right? Okay, so this is voting rights. And whether you are looking at ordinary shares or preference shares, both of them get dividends. But there is one very interesting difference. Preference shareholders get their dividends first, followed by ordinary shareholders. That's why we have this term preference. Preference means that they get it first. They have preference. After that, the ordinary shareholders get dividends. Right. So that's how it works. Now there is another item. But in the event that the company closes down, who gets back their money first? The preference shareholders will get the money back first, followed by ordinary shareholders. But you know what? The banks and lenders take their money back first. So once they take their money back, anything left they give the preference shareholder. If still got anything left, they give the ordinary shareholder. Right, so that's how it works. Right, the three different categories of shares. Preference shares is not a very good investment. Why is it not a very good investment? Because preference shares, the problem is that if the company has a bad year, you get no dividends. Okay, beware. Dividend not compulsory. So as an investor, if you buy preference shares, if you can't get dividend, you can't do anything about it. You cannot complain, you cannot bank table, you cannot go see NP and complain. It won't work. Right? Even if you go to meet the people session, you also get nothing. Right? The same for ordinary shareholders. Even if company don't pay dividends, too bad. Nothing you can do. Nothing at all. Which is why share investment, one of the biggest headache is that you can't get your dividends in a bad year. What about voting rights? Does it help? Unfortunately, if you're a minority, there's nothing you can do. Right? But do you need to know that? No need. Right? So, for purpose of exams, you need to know that with the increase in number of shares, that actually reduces the value per share. That one we'll talk more about it later on. Right? It's not very important now. Okay? But literally it means that the more shares there are, the lower the asset per share. Right? Okay, so that's pretty much it. And then when you come back the next lesson, we will talk more about this topic, especially how to prepare the balance sheet. Okay? So I'll see you soon.